Hey y'all, how's you doing? So as you know, Felipe here to keep you up to date with current market news, teachings, and everything tech. So in this video, essentially, I'm gonna just go over a particular area of finance that I've had some pretty good results over the last couple of years, which is mergers and acquisitions. And that is essentially earning returns up to 30% on average in that specific niche, which I'm like, hey man, I like this area. Why would I not want to kind of dive in a little deeper and understand it a little better? So I did that. I essentially picked up this book, The Art of Merger and Acquisitions. Pretty beefy book, but it has some really good information on it. It's by Alexandra Reed LaJox, a very smart woman who essentially carried over all the stuff she learned from her father, which was involved in the area of merger acquisitions for pretty much his whole life. So it's pretty interesting to get the opportunity to learn from them, considering they've spent their lifetimes in that specific field, right? Mergers and acquisitions. So I'm going to go ahead and jump right into it and some things that stood out to me, and then I'm looking forward to implement this newfound information, right? So mergers and acquisitions, I'll just be essentially referring to as M&A. So when you hear M&A, I'm essentially referring to mergers and acquisitions. So cool thing is Warren Buffett has philosophized that there is only one reason for M&A activity, and is essentially to move investments out of cash into assets. A typical complex closing for a merger and acquisition has three distinct phases: one, the pre-closing process; two, the closing itself; and three, post-closing matters. The areas we're essentially interested in are the first two phases, if we're looking at it as just solely what we can make out of the merger and acquisition, right? Which is the pre-closing process and the closing itself. However, if it's a great investment opportunity where the acquiring company is acquiring the target company, right? And they're going to implement it into their business, it might be a good implementation to the acquiring company, right? So in that case, you'd be interested in the third phase, which is the post-closing matter. So this area is very, very important in finance these days because private equity, right? Private equity is huge. The market of private equity is larger than most of the countries in the world. The market alone here in the United States for private equity, without considering international private equity, which is even larger, I would say. So merger is a narrow technical term for a particular legal proceeding that may or may not follow an acquisition. Merger has a strictly legal meaning and has nothing to do with how the combined companies are to be operated in the future. A merger occurs when one corporation is combined with and disappears into another corporation. A merger can instantaneously prepare a weak competitor into prominence or strengthen an already formidable one. And this is by Michael Porter, who is, I don't know if he's still around, but this guy is brilliant in the context of business. He wrote some really good books that I definitely recommend. I've read one of them, which is Competitive Advantage. Acquisition is a generic term used to describe a transfer of ownership. Value is intrinsic worth of an asset, whereas price is what a buyer has paid. Price is what you pay, value is what you get. And that's by the Godfather himself, Warren Buffett. Price changes daily, value is more stable. So some good stuff there. A valuation multiple is simply a means of expressing a firm's value relative to one or more key financial metrics that presumably relate to that value. It can also be called a valuation ratio, since a ratio is another way of expressing a multiple. For example, if a company with $1 million in revenue is priced at $3 million in the market, right? The relationship of transaction price to seller's revenue can be expressed as a 3-to-1 ratio, right? It's selling at the market 3 times what revenue is, or as a 3 times revenue. Discount cash flow, which is a formula used a lot in mergers and acquisitions, I would refer to it as DCF. Evaluates companies on individual basis. The comparable companies approach considers valuation relative to target peers. DCF analysis is widely used analytical framework for measuring the present value of multi-year cash flow. In its simplest application in the world of M&A, a DCF analysis estimates the value of a business based on projections of how much cash the business will generate in the future. These cash flows are discounted because a dollar earned in the future is worth than a dollar earned today, given the time value of money. That is super important in finance. Why is a dollar worth more today than a dollar is worth more in the future? Think about that for a second. Because you can earn interest on that dollar today, whereas you wouldn't be able to if you earned that dollar in the future, right? And in addition, you can factor in the erosion of inflation, right? So that's a huge principle. A dollar today is worth more than a dollar in the future. Tweaking the analysis, DCF also enables an acquirer to explore whether a particular target is likely to generate sufficient risk-adjusted returns. When I refer to company, I mean the company that is going to acquire the target. The target is the company that will be merged into the company, right? So company is the acquirer, target is the one that's going to be merged. DCF looks at one company and it looks into the future. It predicts how well the company will do in terms of future free cash flow. What is future free cash flow? I'm happy you asked. Money left over after paying all necessities, so operating expense, bills, all those things, and taxes, and what's left is free cash flow, right? It skips historical analysis in favor of basics. Cash is cash, and cash is good. Multiple analysis looks at many companies and looks at the past. It tells you what kind of ratios have held true for comparable companies in past years. Comparable companies, this is like the example of when you're purchasing real estate, right? And your real estate investor does the comps for you in the area, right? To kind of get an idea of what the properties in a specific demographic area have sold in recent times. Therefore, based off sizing and similar housing type, your house might potentially be worth X amount, right? So it's the same kind of idea. Also multiples analysis uses a variety of accounting numbers, time sales, time profits, and so on. They may or may not indicate true economic value. Free cash flow, I'll go a little further on this here because this is super important to stocks and business in general, right? Is the cash that a company throws off during a particular measurement period after all cash expenses have been paid. Free cash flow represents the actual amount of cash that a target has left from its operations that could be used for investing or financing activities. Investing such as merger acquisitions, or investing in other equities, or investing in things that are going to provide an interest return, or financing activities such as purchasing a property and equipment, things along those lines. Examples of such activities include paying dividends and buying back stock, which ultimately produces value for shareholders, right? Free cash flow to the unlevered firm are the cash flows generated by the target that are available to both debt and equity holders. From here, the analysis subtracts financial expenses, both interest and preferred dividend, which is preferred stock, to calculate free cash flows to common equity. This is the residual cash flows available to common shareholders after requiring financing expenses are paid to creditors and preferred shareholders. This is just me breaking down a term that, like, for some reason my brain had, I learn it and then I don't know it, but I don't understand it. So it's good to kind of like get the repetition, at least for me personally, to be able to understand what this specifically means when a business refers to it. And that is a plant. What the hell is a plant? In the context of business, of course, is a production operation at a defined physical location. It is usually envisioned in a manufacturing context. A plant's major assets include real estate, structures such as foundations, buildings, frameworks, and related improvements, equipment for production, communication, controls, and administration, distribution assets such as piping, conveyors, and docks, wiring and instrumentation for electrical supply, communication, and controls of operations, and software. All these things are essentially what a plant means when you look at it within a financial statement, for example, and a business refers to plant in this example. In a service context, a plant may be a physical location in which services are performed. Examples of a service plant include a computer processing facility, a branch bank facility, and a phone operation. Another term that for some reason sometimes eludes me, but here it is, and it's an important term. Oligopoly, if I even pronounced that right, is a market structure in which a small number of large firms dominate an industry. Think about technology, right? For example, your Googles, your Microsoft, your Meta, right? Most technology companies and startups are not able to compete with these companies, and therefore most of the time when startups have good technology, they're just acquired by these larger companies. These firms hold a significant market power, meaning their decisions about pricing, production, or marketing can influence the entire market. Why? 1, fewer sellers. 2, interdependence. 3, barriers to entry. 4, product similarity or differentiation. 5, potential collusion. The comparables approach, which again goes back to what I was talking about in the context of real estate, right? You want to kind of understand what are the properties in this specific location are selling for that are similar to the property that I'm looking to buy or sell. And then you kind of get an idea of what similar properties have sold for in recent time, right? So the comparable approach is a 2-step process. First, we compare one company to another company. Second, we compare one transaction to other transactions. Both of these comparisons involve a series of questions that deal with valuation multiples. The comparable companies approach to valuation is the most widely used methodology in corporate finance. It involves contrasting the financial metrics and valuation multiples of peer groups of companies, generally publicly traded companies, right, to those of the businesses being appraised, known as the target, right, the one that's going to be acquired. Comparable companies should be comprised companies that are similar to the target. That is, the comp should be from a similar industry, of approximately similar size, with similar growth trajectories, and so on. Kind of like the real estate example I keep going back to. A corporate acquisition is the process by which the stock or assets of a corporation come to be owned by a buyer. Buyout is used to describe a transaction in which an acquirer, such as a private equity firm, takes all or part of a public company private by purchasing all of its equity and or assets. Leverage buyouts, which has been huge, over the last 20 years, in which all or part of a company's capital stock or its assets are purchased with borrowed money, with assets of the target serving as a primary collateral for the loan, resulting in an above average percentage of the company's new capital structure to be in the form of this acquisition debt. The cash flow of the acquired business are then harvested over time and used to repay this debt. And these are forms of the reasons or strategies why acquisitions, mergers and acquisitions do occur. A strategic acquirer, sometimes referred to as a corporate buyer, is generally an operating company with at least one and perhaps several business lines that is considering whether to transact with another operating company to either grow or more narrowly focus the acquirer's business. Financial acquirer, usually an investor group such as a private equity fund, making an investment in a company with the specific intent of reselling it later at a profit. This is kind of where private equity kind of comes in, and why they're kind of like the sharks, because they purchase sometimes troubled businesses facing bankruptcy or already in bankruptcy for cheap, and they essentially try to just put makeup on the pig, so to say, to resell it later down the line for a profit after the acquisition. Acquires, buying companies to engage the talent of their founders. This is a new twist on the roll-up strategy. You see a lot of this in the tech market, where big technology companies essentially acquire startup tech companies or already mature tech companies with the idea of bringing in the talent from that other business. Horizontal opportunities are those that involve direct competitors or companies in the same business in another market. A horizontal play can be accomplished by merging with a single competitor of a similar size, a merger of equals, or by buying up many smaller companies in the same industry, a roll-up. M&A that involves horizontal opportunities are more likely to be scrutinized by regulators than vertical plays, although both are perceived as potentially anti-competitive. What does that mean, scrutinized by regulators? They, like the FTC or the DOJ might potentially get involved if they see the acquisition as a anti-competitive play, right? As a monopoly creating a conglomerate. They might at that point kind of step in and try to prevent the acquisition from occurring. Doesn't always happen, but it's something that you kind of have to keep an eye on, because it's one of the risks of M&A. Vertical opportunities are those that involve companies that operate in the same supply chain. The constituent companies are not competitors, but rather involve some type of vendor or customer relationship. Vertical opportunities occur when a company buys a supplier. Vertical backward integration or customer vertical forward integration. Diagonal opportunities include product and market extensions, that is, new products for existing markets or new markets for existing products. These deals are generally oriented towards revenue growth, or it may be a matter of survival. For example, a company may plan to move out of a legacy industry and into a new one by, for example, 2023. Divestitures and acquisitions will typically play a major role in such a plan. Divestitures are the opposite of investing, right? Instead of growing, you want to reduce your size, so you sell assets and so forth. M&A integration refers primarily to the art of combining two or more companies, not just on paper, but in reality, after they have come under common ownership. An example of this, which I think I made a video about, was the acquisition of Hess, which had huge rights in Guyana for oil production and extremely great land for that kind of production. They were acquired by Chevron, right? And now Chevron integrated Hess into their business. Hess no longer exists. So that's an example of the integration. The U.S. has no monopoly on deal making. Many of the largest transactions announced in recent times have been transporter deals that do not involve U.S. companies. including Takeda Pharmaceutical Co., Ltd., and Shire PLC. So this was an acquisition between Japan and Ireland, which closed in January 2019 for $62.2 billion. So that was a huge acquisition. International deal making often forces buyers and sellers to learn an entirely different cross-border vocabulary, even in the same language. Identical concepts may be expressed in different words. For example, turnover and remuneration in the United Kingdom versus revenue and compensation in the US. So the lingo is fairly different between international borders. Unless the product manufacturer or distributor by the foreign entity enters into a stream of commerce in or causes a direct anti-competitive effect inside the US, U.S. antitrust law will not apply to the acquisition or to the operations of an entity thereafter. This is where the Department of Justice, the DOJ, and the Federal Trade Commission, the FTC, have issued guidelines that deal with these kinds of international antitrust concerns. 3 general forms can be used for the acquisition of a business. 1, a purchase of the assets of the business. 2, a purchase of the stock of the company to be acquired, aka, as I was mentioning, the target, owning the assets. And 3, a statutory merger of the buyer or an affiliate with the target. A forward merger, the target merges into the buyer or a subsidiary of the buyer, and the target shareholders exchange the stock for the agreed upon purchase price. In a forward subsidiary merger, the target is merged into the acquisition subsidiary. In a reverse subsidiary merger, the acquisition subsidiary merges into the target. In a forward subsidiary merger, the target ceases to exist. In a reverse subsidiary merger, the target company continues to exist as an entity, as a wholly owned subsidiary of the acquired company. A reverse merger, the target absorbs the buyer in the form of a newly formed subsidiary of the buyer called a reverse subsidiary merger. A subsidiary merger, also called a triangular merger, is a merger where the buyer corporation incorporates an acquisition subsidiary that merges into the target. There's a whole lot of lingo in this thing. Reverse merger, forward merger, blah, 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 blah. So it's a lot of lingo involved, which I find interesting personally. And it's a good, kind of like a good niche I have found. So some strategies in the area, and kind of like why I've gone a little deep in this, because I've mentioned risk arbitration, which is a way to profit in this field, right? There's additional strategies that, for example, Berkshire Hathaway uses, General Electric have used, and I'm hoping and I'm sure that most people are familiar with Berkshire Hathaway. That's Warren Buffett and Charlie Munger, right? Rest in peace, Charlie Munger. A strategic approach treats each acquired company as a new member of its corporate family, whether its industries are diverse, for example, Berkshire Hathaway, General Electric, or focus, such as Cisco, General Dynamics. Strategic acquisitions, commonly referred to as mergers, often involve combination of companies in the same or related industries. Mergers within the same industry can reduce costs, usually by increasing purchasing scale or reducing the cost of payroll by laying off employees, and or increasing revenue, usually by increasing the customer base. So that is the strategic approach, right? Now, financial acquirers, which is typically in the world of private equity, have no intention of integrating the resources, operations, or technology of the acquired company into their own. These acquirers, which are typically but not always buyout funds, do not so much manage or monitor the resources they acquire. Thus, a financial approach treats each acquired company as a separate entity. In such an approach, exemplified by the buyout firm of Colbert, Kravis, Roberts and Company, KKR, the buyer tries to add value through imposing superior top-down management strategies in a short period of time. Financial acquisitions can be fairly diverse, although these transactions may build on the acquirer's expertise. They need not to be integrated into the acquirer's operations to yield a good post-merger return. Some important accounting terms and ideas when you kind of look at these opportunities. The main tools for financial control is the set of processes known as internal financial controls. An example of this is, and I think I made a video about it, I'm pretty sure I did, is SMCI, a semiconductor company, right? They're a publicly traded company. In my opinion, they were doing accounting fraud, and they were not following the processes known as internal financial controls, which is why their stock went from something crazy like $500 a share to where it is now, which is somewhere around like $30 to $50 range, which is still amazing to me that people are like shareholders of that company, considering the sketchy stuff they've done, and they have history in the past of doing such sketchy things. I personally like to stay away from companies that I believe have no integrity. Material facts are those that are important enough to influence the buying or selling decisions of an ordinary, reasonable investor. And this goes into essentially law, right? What is a reasonable investor? A reasonable investor would be an investor that, given all the valid information, is able to make a reasonable decision on the investment. Something that prevents that investor from having said, full scope of information to make an appropriate investment decision is considered a material fact. Pro forma financial information reflects the impact of historical financial statements of a particular business combination and its financing as if the transaction had been consummated at an earlier date. Information is material if there is a substantial likelihood that a reasonable, this is like the highlightable word or the word that you put in bold or whatever, reasonable shareholder would consider it important in deciding how to vote. Because the reasonable part comes into the court, right? When the court, when someone sues someone for whatever, in this context, the thing that's gonna come out is typically the term reasonable. Would a reasonable shareholder consider said information to be important in deciding their investment opportunity, for example? So that's where a lot of court cases come down to, that kind of lingo. Regulations and law, which is a huge part of merger and acquisitions. In the U.S., by state corporate law, directors alone can make such decisions, such as M&A, merger and acquisitions, right? They may not delegate the decision to management. In some cases, stockholders must then ratify the board's decisions through stock shareholder votes, right, on whether they approve the acquisition or not. Some transactions, M&A, require approval from multiple authorities. A good example is the merger of Bayer and Monsanto, which was reviewed by the European Commission in cooperation with the U.S. Department of Justice, as well as authorities in many countries. If the acquisition raises antitrust concerns, the government may extend the waiting period by requesting additional information from parties. In that case, the waiting period is extended for 30 days. 15 days in the cash tender offer. Past the time when the additional information is provided, the parties may request early termination of the waiting period where the acquisition raises no antitrust concerns. The government may grant the request at its discretion. Publicly traded companies must file a registration statement on Form S-4, which you can find in the Securities and Exchange website. They have a really good database called Edgar database where you can search all these kinds of forms on publicly traded companies when undergoing an exchange offer or when registering securities to be used as consideration in a deal. A letter of intent, or LOI, also known as a memorandum or an understanding, is a written instrument that defines the respective preliminary understandings of the parties about to engage in contractual negotiations. Bring down condition. The most significant condition is the bring down condition, which makes the buyer's obligation to close contingent upon two factors. The buyer would not be required to close if 1, the seller has breached any of its covenants, or 2, any of the representations and warranties of the seller and target were not true when made or are not true on the closing date or as if made on the closing date. Regulations, more regulations, financing out condition. These are conditions on legal documents and so forth. Sometimes also referred to as the financing contingency. Provides the buyer the need to not close if it is unable to finance the transaction. So essentially, in the contract of the merger and acquisitions that lawyers spin up or whatever, there's a financing out condition. If the acquirer cannot get the financing to acquire the targets, that's a way out for them out of that agreement. Simultaneously signing and closing. Sometimes the parties will want to execute the agreement at closing. Bankruptcy laws suits. Failure to pay off debts when they become due is sometimes referred to as equitable insolvency. Bankruptcy, right? Corporate liquidations occur when a corporation ceases to be an ongoing concern. Another accounting term. What's an ongoing concern? An ongoing concern is essentially a business that is able to meet all its liabilities, debts, and it's able to conduct its business profitably, right? Piercing the corporate veil on the principles of general corporate law. Owners of limited liability entities can in rare circumstances be held personally liable for the actions and or obligations of their business. Advance approval from the IRS is not required before consummating an acquisition, divestiture, or reorganization. Ordinarily, the IRS will not have occasion to review a transaction unless and until an agent audits the tax returns of one of the participants. A grace period is a period of time following the due date from making the payments, during which may be made and default may be avoided, right? So sometimes in lieu of default, certain creditors will have grace periods in place for their borrowers to prevent them from going into default/bankruptcy. More common are grace periods for interest payments or fees. Cure periods apply to default triggered by covenants. That's a hard word to pronounce for me. Covenants, contract breaches. Intercreditor issues, big in the merger and acquisition niche field, whatever you want to call it, are legal and business conflicts arising between two or multiple lenders. A major area of differences relates to 1, subordination provisions, and 2, rights to collateral. Collateral is the asset itself, right? That may have value in the term of the liquidation. Do not underestimate the importance of these issues. Intercreditor issues can give rise to serious negotiating problems and even imperil the deal itself. Most intercreditor problems arise when two creditors are negotiating subordination rights or rights over collateral and encounter an issue that has not been raised and resolved as part of their respective loan commitments. Kind of like a nerdy thing, but I find this stuff cool. So in merger and acquisitions world is very thick with as you probably noticed already with legal terms, a lot of them go through court cases and all these kinds of things. So a lot of law applies to this specific area. And there's doctrines. Doctrines are, for example, principles that have been established in court based off of the conclusion of a specific case in the past, right? Precedents, where based on that doctrine that's been established in court, that principle states what is right or wrong. So anything that deviates from the doctrine / principle is considered to be wrong in the eyes of the court. But the things that fall within the parameters of the doctrine are considered to be okay. So under Revlon, which is a doctrine, a board of directors may pursue a transaction it reasonably views as most valuable to shareholders, so long as the transaction is subject to an effective market check under circumstances in which any bidder interested in paying more has a reasonable, that word is like super, it's like in all the law books, reasonable opportunity to do so. Revlon doctrine. Although the Revlon doctrine requires boards to obtain the best transaction for stockholders, this is not always a sale. It may mean remaining independent and not engaging in a transaction at all. When a sale of a company becomes inevitable, the duty of the board of directors changes from preservation of the corporate entity to maximization of the company's value at a sale for the stockholders' benefit. The final point has come to be called the Revlon doctrine, or another way of saying it, the Revlon principle. History, I always like to throw some history there because, as Mark Twain said, history rhymes, right? At late 2018, increases in bond yields, essentially Federal Reserve increasing interest rates, right, to fight said inflation or whatever they're attempting to do, or cool off the market or whatever they're attempting to do. So in 2018, increases in bond yields and corresponding drops in bond prices, because they're inverse, caused some to speculate that insurance companies, pension funds, and other buyers of corporate debt would dump their holdings, driving bond prices lower. Because the less demand there is for bonds, which is one of the larger markets in the world, it's the debt market, the less demand for bonds, the higher interest rates go, right? Because investors are going to expect to get paid more interest when there's less demand for said bonds. In 1995, and this is beautiful here, this kind of explains what's going on, and I'm pretty certain we're going to repeat the dot-com bubble, if not already, based off of the tech companies have been dropping large percent. Their stocks have been gone down by a pretty large percent, and that includes Microsoft, Amazon, and a lot of these big corporations. In 1995, 39 stocks contributed 50% of the performance of the S&P 500. In 1996, 24 issues are stocks, companies. 24 stocks, companies contributed 50% of the positive performance of the S&P 500. In 1997, 11 issues were responsible for 50% of the S&P 500 positive performance. If you look back into recent, what was going on? The Magnificent Seven. 7 issues, 7 companies were responsible for the positive performance of the S&P 500 in recent times. Isn't that fascinating? I don't know. That's pretty cool to see how, as Mark Twain says, history rhymes. And lastly, I'll just finish it off with a great quote from the legend Phil Fisher, which is one of the guys that Warren Buffett states he learned a lot from and credits for a lot of his success in finance. Phil Fisher. The stock market is filled with individuals who know the price of everything, but the value of nothing. That is a pretty cool quote. Great. I appreciate you guys for listening in. Hopefully this is something of interest to you. I've made money with this information and I will continue to do so. That's why I decided to dig into it a little further. With that being said, I'll talk to you and I'll see you on the next one. Have a good one.